everyone! Welcome back to my channel where I break down the world of investing and finance. Today we are diving deep into how one of the greatest investors of all time, Warren Buffett, interprets financial statements, specifically the income statement. If you have ever wondered how Buffett picks winning stocks, this is for you. First up, revenue growth and consistency. Buffett looks for companies that show consistent revenue growth over time. Why? Because steady growth indicates a strong and stable business model. If a company's revenue is all over the place, it might signal underlying issues. For Buffett, the consistency is key. Next, let's talk about gross profit margin. A high and stable gross profit margin is a big plus in Buffett's book. It shows that a company has pricing power or a cost advantage over its competitors. Basically, it means the company has a moat, a durable competitive advantage that protects its market position. Now, on to operating expenses. Buffett loves companies that manage their operating expenses well. Efficient control over these costs relative to profit margin shows that management knows how to run the business efficiently. Consistency in keeping these expenses low is a sign of strong operational control. Warren Buffett evaluates selling, general, and administrative expenses to assess a company's efficiency. Buffett looks for companies that keep selling, general, and administrative costs in check as a percentage of gross profit, showing a strong management team. He avoids companies with sudden spikes, which could signal deeper issues. Efficiently managed selling, general, and administrative costs is a key factor in meeting Buffett's investment criteria. Buffett is cautious with companies that heavily rely on research and development, as it is often indicates the need for constant innovation just to stay competitive. He prefers businesses with a consistent profitability that don't require massive research and development spending to maintain their market position. However, when research and development is well managed and leads to sustained competitive advantages, it can still meet Buffett's investment criteria. Buffett views depreciation as a real expense that reflects the wear and tear on a company's assets. He prefers companies with lower depreciation relative to their earnings, as it suggests the business isn't heavily reliant on expensive depreciating assets. For Buffett, companies with manageable depreciation expenses are more likely to have durable profitability and meet his investment standards. Let's talk about debt and interest expenses. Buffett prefers companies with low debt levels. High debt can lead to significant interest expenses, which eat into the profits and increases the financial risk. He looks for companies with a strong interest coverage ratio, meaning they can easily cover their interest payment with their operating income. Operating income, or EBIT, is another critical factor. Buffett focuses on how much money the company makes from its core business operations, excluding things like interest and taxes. He looks for companies with strong and consistently growing operating income. As this shows, the business model is profitable at its core. Net income and earnings per share, or EPS, growth are also crucial. Buffett wants to see that a company not only makes money, but also consistently grows its earnings over time. This growth in net income and earnings per share means the company is becoming more profitable and increasing shareholders' value. Yeah, and that's all. So thank you for watching, and if you found this breakdown helpful, make sure to give it a thumbs up and hit the subscribe button for more insights into the world of investing.